Okay, let's look at what's happening in the S&P 500. Okay, so we look at our stochastics for the S&P. We are basically, you can't get any closer to this top of this channel. That's why we're basically been sideways today. We were totally overbought. This is the most overbought we've been for a really long time. So we have our timing, for this situation is, we're extreme overbought. We're at the top of the channel in the S&P. So, but we also have a momentum, which for the past 10 days, it's achieving this certain kind of momentum that's good. I mean, advanced decline in the S&P, in the total stock market is it only happened 45 times in the past 50 years or 100 years. So we do have some momentum in that sense, but on the other side, we do have this overbought right now. So let's keep that in mind. And let's look at where the S&P is right now. We're battling this top of this channel, and until further notice, we're still in a bear market, and the next leg down is here unless we can find a way to get out of this channel. And let's look at some of our meeting notes. This is the start of earnings season again. We're starting with the bank earnings. So we're in right here. So we're going to have bank earnings first. We're going to have the tech earnings, the big tech stocks, probably in the first week of February. So that's, I think the consensus is we're going to one of two things. Either we're going, right now is the time we have pre-announcement season. This is like a pre-announcement. If there's bad earnings for tech, which is happening around February, first, second week of February, they're going to pre-announce now. So, and we've noticed that companies like Apple, that they expected not to do as well, they didn't pre-announce. And we also have a kind of a negative sentiment in the market, even though today we've had some pretty decent earnings. The stocks went down, even though they had better than expected earnings. So we have to remember in the back of our minds that buying a rumor, selling the news, something that's obvious to the whole stock market. Like most of the market people on TV are saying the first 6 months of the year are going to be flat and bad, and then the last half of the year is supposed to be good. So who knows? I mean, that's what everyone's saying, but a lot of times the market does the opposite of what you think it will. So let's look at more things here. Okay, so the S&P is kind of flat. We're kind of stuck at the top of this range. The things that are doing the best today in the stock market are the banks. A lot of the banks that are reporting, they start out negative and then they're going up now. For the banks, they put away a lot of loan loss reserves. So that's capital they can't put towards growth. They put a lot for this impending recession. And whenever there's a recession, there's usually people defaulting on their credit, such as not paying their credit cards or not paying their mortgages, etc. So banks take losses a lot of times during a recession. But the banks are basically turning to a softer stance, and they're saying it's not going to be a hurricane of a recession. It's going to be a mild one. That's just today they said that. So, but I think the earnings were as of this morning, they were. This is my talking points here. Hold on. There. So some of the earnings that came out today, they were better than expected, but the pre-market which is when I wrote this, they were all like negative, and I'm like, wait a minute. Whenever the market reacts negatively to good earnings, that's kind of an interesting why would that happen? If they were such great earnings, why would they be negative? So we have decent earnings here in the we have a EPS beat and sales beat for a majority of these companies reporting today. We've been watching United Health as a really large company, one of the largest in the United States, and it's still growing, and it's a good way to diversify what we're doing, and it's fairly valued too. Let me see. All right, let's go back to our talking points here. Let's see what else is doing good and doing bad. The ones doing bad, I don't know if these, we have General Motors, Ford. Okay, so we have some car stocks. We have airline stocks. All right, so we have airline and defense. All right, so Raytheon, General Dynamics, Lockheed are all defense. So maybe one of them reported bad earnings. I don't know. This was defense sector was one of the sectors that held up last year because there's always money coming from the government for defense, and that's one of your best customers. Look at the Nasdaq. This is the eBay. Mercado Libre is the eBay of a different country. So it's going up 6%. That's on our screen. We did a screen today. We did a screen today. I'm going to open it up in a different window. Okay, we're going to open up this screen. What I did was I made a screen in Fidelity. Hold on. Okay, Mercado Libre was one of those stocks that I saw there. MELI. Let's look for that. MELI. It's not in there? Okay. Well, what I did for this meeting is I said, well, every once in a while we like to do a screen. What I did was I highlighted, let me see, 161. I tried to focus on the biggest companies in market cap. So these are all mega cap, large companies. And what I did was I sorted based on the best PEG ratio, the best return on equity, and every one of these things we're looking at, and the best dividend yields. And I highlighted the best that I could find in orange, and then the next one. This is the best 10%. This is the best 20%. What I did was I just looked over a couple of these, and we're going to go over some of them. A lot of the energy stocks, a lot of these energy stocks showed up as very low PEG ratios, but every time I looked at the energy stocks, they're in the E-Trade earnings estimates, they all ended up being a false warning, and that they're not projected for the next coming years to be growing as shown here. So I basically did a screen. We'll go over some of these stocks later on. Okay, let's look at some more things that are going up today. We have anything in common. Things are going down. Okay, the car stocks are going down in the Nasdaq. Lululemon. I don't see any common stock there. Let's look at, okay, bank stocks are doing the best. Banks and financials. The ones doing the worst are We have drug stocks. Mark, Johnson & Johnson, and telecommunications, Verizon. All right. So I don't see a commonality in these at all. Okay, let's look at what else is happening. We're still flat in the S&P. Okay. So we're going to go over some of our notes we put together for today. Okay, so
one thing I will say about the bank stocks is I guess I had thought they had been hammered down a bit, but no, they've been going up since September. I didn't realize that.
Let's look at the stochastics for the bank stocks, just because we like to keep track of these.
Yeah, bank stocks is open. They just rates are up.
Banks do better when the interest rates are up. So let's look at.
That's why they started going up since September.
Yeah. No, yeah, I didn't realize that. Yeah, that I knew that they just the last few weeks they had been down a bit, but yeah, their earnings apparently they're doing well in earnings.
Looking for Excel. There it is. Okay, so basically they've been flat for a while, and I mean for at least since last June they're in a trading range. So along with let me see. I guess the reason why they've held up last year and have gone sideways is most of them pay a dividend, and they are helped by rising interest rates because there's like something called net interest margin, and let me see. They're hurt by the yield curve, which is the difference between short-term and long-term treasuries. Because banks basically they borrow short term and lend long term. So they have a lot of skin in the game when there's interest rate changes. But they've been flat for a while now. They're at the top of their trading range. So it looks like they're building some momentum here in the short term. You can see like an uptrend. But I've owned JP Morgan for a long time, and my theory with the banks is it's really hard to become a really big bank, and they have powers of scale, and they can be more efficient than smaller companies. The reason why the banks have been floundering for the past year or so, like Goldman Sachs and Morgan Stanley, JP Morgan, they make a lot of money doing IPOs and business transactions, and that's been pretty much flatlined for the last year because of just the market going down. Who wants to IPO during a down market? Not a lot of companies. But as the stock market recovers, there's going to be an increase in that kind of activity, which will help the big banks. So let's look at.
Yeah, my issue with the banks, I have a hard time kind of understanding them, and kind of their long-term prospects. And also I think the executives often capture a lot of their upside in terms of like their bonuses and stuff. It seems like the big banks, they when they have good years, I think they give good bonuses to their executives. So I think more of the profits go to the executive team, than in a lot of companies compared to the shareholders.
One thing Louis Navalier said, he's like a banking analyst. I listen to him all the time. He used to be a bank analyst, and he said banks can basically manipulate their earnings very easily, and it's really hard to understand what's going on. Like for some of the things we're watching, like Google, it's pretty simple. They sell ads, and they have expenses. That's an easy, business to understand. But for companies like the banks, it's a lot like Berkshire Hathaway. We don't really understand a whole lot about, the whole company. You just have to, you have to trust what they're doing. So yeah, I'm sorry. Go ahead.
Yeah, it's interesting. Goldman Sachs has done a lot better than JP Morgan over 1 year, 2 year, 5 years. It seems like you said you own JP Morgan. Goldman Sachs has been doing better for quite a while, it looks like. So I don't know how to say which is a better bank. It's hard for me to pick, right? Like, it's hard for me to know.
That's okay.
You're gonna do better.
Let's look at Goldman Sachs and JP Morgan just for fun. Let's go back. We'll do a comparison between the two. Okay, we'll do Goldman Sachs. Okay, so we can see Goldman Sachs. It's paying a dividend of 2.7%. That's not bad. And doesn't have a PEG ratio. Its PE ratio is only 9. I'm gonna look at this and okay, so its PE is 9. It has decent numbers for our, what we're looking for. Look at the earnings prospects for this company. And we'll also look at the chart of both and compare both to see. Okay. We're going to do a comparison with which one, JP Morgan? Okay, Goldman Sachs wasn't always a bank. It wasn't until the great financial crisis that it turned into a bank. So now it used to be just an investment company.
And it was a partnership.
Partnership?
It's no longer a partnership.
Wow, look at that.
Way back when.
It used to be a partnership?
Pretty sure. I think it was the executives were the owners.
Wow.
Back in like the 80s.
I didn't know that.
Pretty sure.
Okay, so we look at JP Morgan. You're right. Goldman Sachs has done better since we go back the maximum. Let's go back 5 years. It's about the same, almost exactly the same, with Goldman Sachs doing just a tad better. 45% versus 23%. Yeah, much better. So it's basically in line. I guess all banks trade together. Let me see. Let's look at the earnings projections for Goldman Sachs compared to JP Morgan. Now there's a lot of scale here too. These companies can't grow as much as they used to because they're becoming really big companies. Let me see, 30. Okay, so we have three or so years of growth. From 2022 to 23. We're going from 23 to 24. 36.21 divided by 41.47. 13%. Then it's going to go down 36.58 divided by 41.47. 12%. So that's pretty inconsistent. I guess what you have to do is when you're analyzing, these people that are making these estimates, maybe they're saying, we're going to, how could they predict this? I don't know. But it seems like it's going up 13%, down 13%. Let's look at JP Morgan. I'm guessing JP Morgan has maybe 5%, but it's consistent growth. Let's look. Earnings. Oh, they're also 2025 seems. I guess all the banks are the estimates are similar in nature. So you're growing like 5 or 10% from this year to next year, and then you're going down the same amount. So for some reason, the analysts all think the banks are going to be doing bad in 2025, worse than 2024. Maybe that's just an interest rate thing. They just have to guess that, how much they make, in what they do. Maybe there's a lack of IPOs 2 years from now. I don't know, but how they come up with that, we don't know. But they're very similar. Let's look at the 129 divided by 1 thing. 7%. That's 6%. They're going up 6% and then 1.3. Down 6%. Okay, so looks like Goldman Sachs is a little bit. It's like double the performance, but we'll never understand banks. Who are we kidding? Banks are really hard to figure out. Okay, so right now it's like a sideways. We've had a couple different sectors that are starting to break out of channels. I'm going to highlight those a little later. Let me see. But the 10-year and the 2-year, we had a situation on Tuesday where, I forget what day it was, Thursday, we had the PPI come out. And as soon as the PPI came out, the 2-year and 10-year went down. And for the week, they're down 8%. And that's a good indication that the Fed never fights market rates. So we watched 2-year, and the 2-year is down, which indicates that the Fed will probably not raise as much. So they're saying between 0.25 and 0.5% at the next meeting, 25 to 50, and that's it. But that's interesting that the 2-year and 10-year went down. So that's good for our interest rate watch. And we have this month, this whole 6-month yellow here until the end of April, because the Fed is still reducing the balance sheet, which reduces the amount, which increases the cost of most companies to borrow money, and the interest rates are going up. So we have a holiday this coming Monday. So that's a good indication that people are happy towards a holiday time, and there's people taking off. We're going to have a off day on the stock market on Monday. So we usually have a green or a good day before a holiday, but this is a new holiday, so people might not be ready for it. We're starting earnings season, and a lot of times that's a catalyst for stocks to go up or go down. So we're starting with the banks today, and we're going to end with this is when the tech stocks come up with their earnings, which affects the market a lot. So let me see. We're currently overbought. We're more overbought. I missed that. We're more overbought than any time in the most recent history. So there's a very good indication that we could be going back down to here. But we do have a lot of momentum in the last 10 days, which could push us out of this. So we have this whole battle and this whole number. This is why we're flat today. We're trying to break out of here, and if we don't, go back down to here. Okay, so now what other talking points do we have? Okay, oil is up 5%, and inflation is at 6.5%. The PPI basically told us that. But the thing that a lot of people on TV are saying that we're up 1.8% annually in the past 6 months. So year over year, we're up 6.5% on the PPI, personal, whatever, consumption, PCI. But for the last 6 months, we're only increasing 1.8%. That's the Fed's target rate. So if we continue to only increase 1.8% on an annual basis going forward, the Fed has no reason to raise interest rates anymore.
So the index that you're looking for is there's the consumer price index, but I think the Fed uses the PCE, which is the personal consumption expenditures.
Oh, right. Yeah, the personal consumption expenditures. I think one of the biggest parts of that is housing costs, like the owner's equivalent rent, they call it. And that's the one thing in this most recent report that didn't go down a lot. And as soon as that cracks, then I think then maybe that'll start going down too. I don't know how to figure this out. We're looking at stocks. Why do we have to figure out this? We weren't talking about these things like 2 years ago, but now all of a sudden we're like trying to figure out interest rates and personal.
Well, so I think that having to deal with the Fed is one thing, but I think that the macro economy and kind of what sectors are where, and then the inflation and kind of supply chain issues all affect the companies that you're looking at investing in, right? That a lot of these issues do go to their bottom line. How much it costs to borrow money, how much they're having to pay back on bonds, things like that. It affects the business and the kind of profitability of companies in ways that are, I think, important to understand.
Right. And the other thing is the cost of labor too. That's like the other big thing we didn't talk about. That that goes up with inflation, and that might be hard whose salaries go down, when inflation starts to go down. I don't know. But that's the other thing. I guess whenever you take everything into consideration, you have to see how the company makes money and how this affects it. But the earnings projections for a lot of the stocks we're following they're not changing a whole lot, and they say that's one of the last shoes to drop, for this whole market cycle thing with the interest rates is. They haven't reduced the interest rates and the estimates for the companies like the S&P 500 yet. So our when we look at these E-Trade estimates, these are all pretty much unchanged yet. And as soon as the companies start reporting earnings this coming quarter, in the next couple of weeks, we're going to see these go up or down, these forward estimates. And then we got to reconsider our positions and see, projections of the companies in the future. All right. So the other thing is, go ahead. I'm sorry.
I put a comment in the chat. As loath as I am to link to Bloomberg too much, they have there's a podcast that they do called the Odd Lots podcast. There was one recently that I thought was pretty good. And if you're interested in kind of market projections this year and different views on it, I thought it covered it pretty well. So I linked.
Oh, neat. Oh, nice. I'll check that out. Thanks. Let me see. Oh, the other thing is the dollar is down another 2.5% this week. So these are all, dollar is good for multinational companies. So when all the tech stocks are going to report, they're not going to be complaining this quarter of, the dollar. They're going to say that helped them this quarter. So the other thing is the commodities, as the dollar goes down, the commodities prices go up. So gold and oil, maybe that's why oil is going up. But there's almost a 1-to-1 correlation we saw last week. Let's look at, let me see. All right, what we did today is we're doing a screen. I did a screen on Fidelity of large cap companies. I've made sure they're large cap or pretty big, and all the important things that we're looking for that Warren Buffett likes. And we're going to go over those, but I tried to pick out stocks that kind of match this, what we're looking for. A low PEG ratio, like a PEG of 1 or so, or stocks that are, they call it throwing the baby out with the bathwater. Stocks that are compounding stocks that perhaps they've gone out of favor with this environment, that are continually growing. So we're going to do that screen pretty soon. Let's look at what sectors are doing good. We know banks are doing good, but what other sectors are doing good today? Gold miners, home builders, financials, healthcare, ones doing the worst are industrials, utilities, oil. This is like a flip of last year almost. A little bit. Stocks that were, no, this healthcare is doing good. Okay, so this is kind of a flat day. The S&P isn't moving a whole lot. But we like to look at, the what worked last year, a lot of times is out of favor and doesn't work this year, and things are flipped around. So that could be what's happening. What else? That's the sectors. That's a good exercise to do every now and then. Okay, so the S&P, we already looked at this. This is basically the most overbought that the S&P's been in quite a while. We have over 90 in the stochastics. We're at a major inflection point in our downtrend. This won't go down forever. I mean, this is channel. Market participants see this, and if we break out of this, then there's going to be a lot of covering. A lot of people that are counting on this downward trend, and they're just playing this. And as soon as that we have a breakout of this, there's going to be some market reaction to that. We don't know when that's going to be. Okay. So, fear and greed. People are greedy now. So it was neutral last week. So as you get towards, we haven't had greed in quite a while. I mean, it's been a long time. People have been, this has been fearful of the interest rates in the environment where the Fed is causing, the market to contract and earnings estimates to go down. But now people are getting a little more confident. You have the VIX, it's down to like a bull market kind of range. So it's down 14% since last week, and it's like a no fear. People aren't buying protection in the options, and you can see though that when the VIX gets this low, that's like a contrary indicator. We look at it versus the S&P 500. Whenever the VIX is low, that's when the S&P is high. And let's look at the other times whenever the VIX was low. That's when we hit a high and before we started going down. So, but this time is just a little bit different. We've had something called something called breakaway momentum. And I mentioned this earlier this week about this Walter Deemer is an institutional analyst. He's retired now, but he tracks these the percentage up, percentage down for the day in the market. And there are rules that he follows, that, if you have, a certain number of net advances, 9 days ago, there was 2,104. And if you have a certain amount more of advancers than decliners, then that's kind of defining a momentum. And he basically said, as of yesterday, we've achieved breakaway momentum, which this guy kind of said the same thing. He said, the oscillator's high, we're overbought. So this could mean we're either overbought and may see a pullback to relieve that, or it's a strong up move, which indicates still more strength to come. I think Matthew summarized this in one sentence. He said it can go up or down. I think you're right, Matthew. We don't know. We don't know, but this is like you can tell it's a turning point. We don't know if this is going. I mean, I've never heard of I've never heard of that breakaway momentum until I started following this guy. But we got to take the guy seriously, and it's also a trigger of the whaley breath thrust, and both of them triggered the other day. So I don't know. I think earnings are coming up in the next couple weeks. And if we have some decent earnings and not worse than expected, that could break us out of everything, and we could return to some kind of normalcy instead of going down all the time. So, all right, that was a good little fun thing, but don't take this you have to take it with a grain of salt. But I think he's a pretty smart guy, and kind of makes sense that if there's a certain amount of momentum, then there are momentum seekers, and people follow it. Whenever it goes up, people follow that. Okay, that's good. But this other guy's kind of following. There's a chart that basically says every time this breakaway momentum happens, we're up on average 18 or 19% in the next year. So I don't know. It might not work this time. Might be it was negative in the year 1987, which when there was a crash, but almost every other year it was kind of positive. So we'll watch that, see if that has any credence to it. Another guy kind of saying the same thing. Okay, so here's an article by Jim Cramer. He basically said Eli Lilly is the best of both worlds, a recession-resistant stock with major growth potential. So I have just a small amount, maybe 1% of Lilly, but I forced myself to be diversified. I mean, I didn't want to buy it. I mean, it traditionally trades at a high PEG ratio. Let's see what the PEG ratio is now. It's like 2.28. That's pretty expensive. So if it's a PE of 43, it's growing around 23%. So I looked at the E-Trade earnings estimates, and it's growing 14, 30, 25%. And they have a lot of drugs in the pipeline, and so it's a PEG ratio of about 2 to 2.5. So it's really pricey, but I forced myself to get it just for some diversification, and it seemed like it was growing consistently. So, and it pays a dividend of 1.25%. I'm trying to move my portfolio from a high-tech concentration to something more conservative that pays dividends over time as I get closer and closer to a retirement. One of my goals is to get from aggressive to conservative. So I forced myself to get this, and Jim Cramer likes it because it has a lot of drugs in the pipeline. One of their drugs could be the best-selling drug of all time, according to Jim Cramer. It's a weight loss drug that also is used for something else, but it has very, very good results. And they also have an Alzheimer's drug in trials, which might be, a very good selling drug. So those are some catalysts that could help this stock over time, but it's still pricey. You have to be, if I was looking at this, I would wait for a stock market, crash or something and wait for it to go down to like a 1.5 PEG ratio and then buy a little bit, hope it goes to the PEG ratio 1, but it's still a little pricey. But if you want some diversification in your portfolio, you could buy some of this. Let me see. But I like stocks that are projected to go up in a straight line, and this is definitely one that's pretty consistent. And let me see. Make sure I got everything here. Okay. So I want to talk about my screen that I did. I did a stock screen on Fidelity. I'm trying to look for low PEG ratio stocks that have safe business models that are down a lot from historical average, possibly undervalued growth compounders. I call growth compounders the stocks that basically are in most of the mutual funds, top 10 holdings that consistently grow over time that might be down or in this environment might be trading lower. For tech, I want a PEG ratio less than 1 to consistent growth. For drug stocks, I want high dividend and consistent growth. And for defense stocks, I want low PE ratio with a dividend and some growth. So that's kind of the purpose of this screen. And let me see. Okay, so what I did was we'll look at that screen now. So again, like I said, I highlighted the top 10 of every category. So return on equity, this is the highest. So I marked it as orange. So the top 10, I marked in orange. The top 20%, I marked in yellow. And so whenever I do a screen like this, I look at, everything. I say, wow, look at this right here. Occidental Petroleum seems to have a lot of those as PEG ratio 0.21, and it has this return on equity of 77. Maybe that's why Warren Buffett's interested in cash flow increase. But the interesting thing about a lot of these top 10, a lot of the stocks in this screen are oil stocks. But when I went to look at some of these oil stocks in E-Trade, a lot of them were like the earnings projections weren't 26% for the next couple of years. They were going down for the next couple of years. So you have to kind of ignore that. Or, I don't know, it's hard to screen stocks for, it's hard to value oil stocks because it's all based on the price of oil and no one can predict that. So I'm kind of ignoring most of the oil stocks in this screen for now until I understand that better. So, but I did highlight some of the ones with some of the best numbers, return on equity and return on, let me see, we have earnings per share. So this MasterCard, for instance, is growing around 20% and has a high PEG ratio, but it's pretty consistent and it would work pretty decent in this environment. And this is, I put on the end here, the dividend yield. So we have some stocks like Pioneer Natural Resources that are yielding 10, 11%. But the only problem with these are they're inconsistent and they're at the mercy of the price of oil. And no one can predict that. So what I did was I picked out a couple of these. I'm going to go over, which ones am I going to go over? Okay, we're going to go over TSM. Okay, so TSM is one we're going to look at. So it's forward growth. It's supposed to be growing at 21% there. Return on equity is good. And has a PEG ratio of 0.73. So that was enticing. So what I did was I did a screen. Now, I looked at it in E-Trade. It doesn't go out that far. It only goes out 1 year. And it's supposedly growing at 15%. And I looked at the PE is exactly 15%. So this is an example. We were looking at this, a while ago when it was up here, and we were saying, it's a little pricey. Let's wait for it to go back to a PEG ratio of 1. And it finally basically came down to that PEG ratio of 1 now, where it's grown at 15%, and its PE is 15. So this is an example, in times that are bad market conditions, high quality companies that are growing consistently, they basically a lot of times stop at a PEG ratio of 1. So the only problem with this stock is we don't have any predictions beyond next year. So that makes a little bit our confidence in buying this a little bit lower. Let me see. So let's look at, but the profit margin is really good and the return on equity is really good too. So this is like a fairly valued growth stock, and but we're in a market right now where everything is overbought, and so this is example. You can start dollar costing into this, and hope for a market drop to get at a better price later. What I did was I checked in on MasterCard. So MasterCard, it's growing for the next 2 years at around 17%. Its PE is 30. It's always traded at a premium. It's growing. Its PE is 30, and you see it's growing at 17. So that PEG ratio is 1.7. It's always traded at a high PEG ratio because it's consistent. See, this line is going straight up. You can see. and the earnings projection is going straight up. And that's basically our thesis for this company is there are, I'd say 80% of transactions in the world are still cash. Not in America, but around the world. And more people around the world are turning to credit cards. They're a toll collector, so they collect money based on the volume. And there's more and more volume every year. And even in recessionary times, and there's high inflation, people spend less. I mean, they buy less, but they spend the same because the prices are higher. So it evens out for these companies. So they traded a PEG ratio that's higher, but it's you're paying for consistency, and you don't see a whole lot of stocks now that are in a straight line without a whole lot of variations. So let's look at the numbers on here. The return on equity is 145. That's like amazingly different from every other company. Return on equity, ROI is 45. It's growing around 20% forward EPS. Okay, so, but, it's in a really bad market, this stock will trade down to a PEG ratio of 1. See, if you divide the price that it is now by 1.7, and it'll give you what the price will be. So, let's look at another one to do Merck. Okay, we looked at, where's Merck? Right here. This is the mega cap. So it's like $250 billion in market cap. So it's a big company. It's supposedly growing at 11%. We're going to look at that. Return on equity is good. PEG ratio, it's a little bit pricey too. So based on E-Trade, it's growing around 10%. So 2% between this year and next year, and then 15 and 10. So let's average that out at 10. So the PEG ratio is 1.5 because their PE is 15. So if it's 15, they're growing at 10%, then it's overvalued by 1.5. But it's paying a dividend of 2.61%. So this is an example of a stock that's growing consistently over time. It's not going to hit you a home run, but it's going to, you could put it away and it'll pay you a dividend and it'll grow, a certain 10%. So you get a 12% total return by buying this company and holding it. So this is an example of a singles. They make singles part of your portfolio instead of a home run. And it's a little more consistent, and it's people don't want to die, so they'll buy their drugs regardless of the price. So they have pricing power too. So let me see. So you can see from the day Yahoo agrees that it's around 1.4 PEG ratio, and the profit margin and return on equity is good. So that matches stocks we like. But if you want a drug part of your portfolio, this is still a little pricey, but when you know that when the PEG ratio goes down to 1, then it's kind of fairly valued, and you can use that to time your purchase if you want to do that. Let me see. Let's look at bank president. This is Jamie Dimon says we're going into a mild recession today. He just said that. Last year he was saying we're going into a hurricane, and at that time I said he's always given these warnings that don't come out so that you can ignore it, and it turned out to be true because now he's saying that he's not as worried about this being a bad recession, and it's going to be a mild recession. And these and Bank of America said the same thing. It's a mild recession today. So what that tells us, when we look at our chart, of our investing chart, don't expect the stock market to go up, for the first 6 months of this year. It's recessions, stocks go down or go sideways. So whatever worked last year, will work for the first 6 months of this year. So they are saying it's going to be a shallow recession, but it's still a recession. So let's go back to their comments there. Okay. All right. So, but they have their fingers on the pulse of the consumer. They speak in riddles sometimes. They say, well, we're going into recession, but the consumer is doing good and they're holding up. So it's hard to make sense of it, but it seems like it's not going to be as bad as expected. So that affects a lot of the stocks we're watching. Look, when I was doing my stochastics, for all the indexes, I was making notes of what I'm looking at is right here. When stocks and when indexes are breaking out, we're at the top for a lot of these sectors. Meaning we're probably going to be sideways, continue this, but there are some sectors that are breaking out, such as this one, communication. This has been a downtrend forever. And Verizon and AT&T are just starting to show a little bit of life, but you can see that after all this, maybe people like, a Verizon investment now that's paying a high dividend, and that could be a start of an uptrend. So let's look at some other sectors that might be breaking out. You can see that they're all kind of staying in their range here. But look at that one, real estate, just a little bit right there, but it's starting to break out. Energy sector has been sideways for a good part of a year now. Let me see. Let's look at what stocks could be breaking out. A lot of the drug stocks are they've been selling off for the past couple of weeks, but they're still in a trading range here. Abbott Laboratories is kind of starting to break out. It's been in a downtrend for a long time, but it's starting to make a move up. We have Alibaba. We mentioned, it's starting to go up right around here. But I think what happened was, we were talking about it last year, that China was making all these capricious rules that they had to follow, which, made us we're totally not in control of this stock. And they actually bought parts of Alibaba that they wanted when it was down low, like we were suggesting, and now the stock is recovering when they're loosening restrictions. So it seems like China was playing the market to try to get a piece of Alibaba, and that could have been what happened. We don't know. But that's really hard to invest in that environment. See what other stocks are kind of. Okay, there's one. Meta is actually starting a little uptrend here. We don't know if that's gonna hold up, but it kind of broke out just a little bit. And JP Morgan, it's like a sideways. They were in a downtrend, lower highs, lower lows for a while, but they broke out of that, and they're starting to make higher highs, higher lows, like the Starbucks, and they're up today. So it's a very good chance that JP Morgan could be starting to do this, in a higher interest rate environment. See Microsoft? No, we don't have. Okay, there's one right there. Verizon, our communication sector ETF, it broke out of that channel, and Verizon very similarly is breaking out of that. So let's see. Right, Tesla is in a super downtrend here. We were talking whenever the Tesla was up here, it was like 2 or 3 times overvalued. Then it's 1.5 times overvalued. Now it's just about barely valued. And the bad news, there's bad news on the stock, but still it's about barely valued now. So most likely Tesla's going to be in a trading range like this while its PEG ratio is around 1. You see, NVIDIA is breaking out of its downward channel, and it's starting to make these lower highs, higher lows. Nike also broke out of its downward channel, and it's in this kind of channel right now. All right, well, that was a good exercise. Let's see if I have any other notes for this meeting here, because we're almost at the end of our talk. Oh yeah, I was just mentioning, I just did that exercise. Just keep in mind these predictions from pretty smart people, Dan Niles and Leon Cooperman from last week. We're basically right. They say we're going to probably either stay the same, in this trading range the rest of the year, or we're going to be down. 45% chance we're going to be down 20% from where we're at. And only a 5% chance that we'll be hitting new highs around 440 in the SPY. So we'll keep an eye on these predictions. I don't know if they're true or not. I'm 100% invested. I'm not going to be messing around, trading around these positions. But right now we're in greed for our emotional chart. So a lot of people are buying right now. We're overbought. We're totally overbought. Don't get sucked into buying when everyone else is buying and the stock market's going up, because just whenever we get to the point where we're overbought, which we are now more than ever, there's going to be a take back sometime where the stock market gives back some of its gains. So you got to be ready for that. That's called a bull trap. So we're going to be ready for whenever the stock market goes down now. So the key is to either sell or don't buy when it's going up, and when it's going down, you want to buy or don't sell. And let me see. We're in the first half of the year is good for the stock market. Right now, the earnings come out this quarter, and that's why usually there's a positive 1% on average for January. But with rising interest rates, we don't know if this will work this time. So that's the end of what I had to say. I think I'm out of time, so I better get going. All right, well, thanks for attending, everybody.